All right, good afternoon, everybody. I guess you're all in listen mode. My name is Bob Lee, and I volunteer at the Foundation for Financial Education for over a year now. You'll see my name on the bottom there, and Jonathan, the founder, always teases me about all my designations. I spent 31 years in the financial services industry. And so those designations down there are, the first one is Certified Financial Planner. A lot of people recognize that one. These two actually kind of equated to that one before that one came out. So the next one's the Charter Life Underwriter and the Chartered Financial Consultant. Those are just tax, investment, estate planning courses that we take. They're equivalent of probably 10 college courses for those, 5 college courses for that one. CRPC is Chartered Retirement Plan Counselor, and CWS is Certified Wealth Strategist. So 31 years in the financial services industry, but love volunteering for this foundation. They do a lot of great things. In fact, the last month or so, it's been nothing but let's do a food drive. There's people out there that are hurting right now. We need to get, money and food. We're doing a fun GoFundMe thing and a food drive for people that are in need right now because of this virus. Last year we did Kids Got Talent thing, so we had the America's Got Talent winner come to Maryland and do a presentation, and we gave away thousands of dollars in scholarships to students in art and stuff. So it's really, they do a lot of great things. So, and our passion is financial education. So we're going to be talking about taxes and the IRS today. By the way, you have an evaluation form at the very end. Really appreciate that if you could fill that out, because that gives us an idea of other topics that you might be interested in. So we're happy to come back and do different topics. We've got about, I think, 15 or 16 different topics, and we oftentimes are invited back to do different things, different type of financial topics. So we'd be happy to come back and do those things for you. And that's what that evaluation form is for. So I am trying to page down, and for some reason it's not quite working. Okay, there we go. I don't know if Kiana did that. She's my backup. Anyway, just a disclaimer here. This presentation is intended for educational purposes only. We don't replace independent professional judgment. Pentagon doesn't endorse any products or services or third parties. It shouldn't be construed as legal or medical or tax or investment advice. Even though it kind of sounds that way, you need to consult tax, legal, and financial advisors. So just wanted to have to always read this disclaimer. All material, images, graphics are owned and copyrighted by the Foundation for Financial Education. You do have a copy, by the way, in your handouts on your upper right hand. I think you can click on handout, and you have this presentation, and you're welcome to use that in any way you see fit. All right, so that's the disclaimer. So let's jump right into how do I file my return. Now, I am not here to tell you that you don't need a CPA or a tax preparer, but I will say that a lot of you might not. There are software programs like TurboTax, tax preparers, CPAs, they all can get the job done, I guess. Not everybody needs a tax preparer and a CPA. I do TurboTax myself, and I've done it for years and years. And a couple times I've hired a CPA, and they came out with the same number I did. So I pretty much stuck with TurboTax. I'm actually teaching my kids how to do it. It's very simple. And I did this presentation a week ago, and I helped a lady last night, first time ever on TurboTax, and she's like, "Oh my gosh, this is so easy." She was so excited. So, and I'm happy to do that for you as well. But again, I don't want to replace your CPA or tax preparer. I'm just here to say to a lot of people, you might want to consider doing it yourself. All right, so the federal income tax rates, I'm actually going to, so these are the federal tax rates and our deductions. I think this was last year though, because these numbers are a little bit higher. So our tax rates are 10, 12, 22, 24, up to 37% single, married filing separate, head of household, or married filing joint, I'm sorry. They're married filing separate in household. And this shows your tax brackets. And if one thing that I want you to take away from today is the mystery of taxes. My goal is for you to, at the end of this presentation, to say, wow, that's way easier than I thought. Taxes are really pretty simple. So I'm going to go to another sheet that I have that I want to show you, and to show you how simple taxes are. So my kids, for example, are 21, 23, and 25 years old. And dear old dad does their taxes. However, I'm showing them, look how easy this is. Let's say my kid makes $50,000. As a single taxpayer, you have a $12,000, actually it's a $12,400 personal exemption this year. It's just, so $12,400. I got a kid making $50,000. I subtract my 12, let's just say 12 grand. I'm at 38,000 bucks. Let's say I'm at 37 just to make it easy. The tax is $4,453. That's it. That's how simple it is for a single taxpayer, or even a married taxpayer if you're using a personal exemption. Couple making $100,000, let's say. They have a $24,800 exemption. So you're making $100,000, subtract your 24,800, you're at about 70, let's just call it $77,401. Your tax is $8,907. Or $8,907 and 22% anything over and above the $77,000. So I take my income, I take out my itemized deductions or my personal exemption. That gets me to a number. Let's say my income was 100 and some thousand. I take off my deduction, I'm at 80,000. So I'm at $8,907 plus 22% of about $3,000. It's about 600 bucks. So I'm about $9,500 in taxes. That's the tax I owe. That's how simple it is. Then I look at what I withheld. So if 9,500 was my taxes, I withheld 9,800, I get a $300 refund. If I withheld 95, when my tax is 9,500, I withheld 9,000, I owe $500. So it's really pretty darn simple. And that personal exemption that increased so much made it a lot easier, because if you itemize, great, you got charitable gifts, mortgage interest up to $1 million, up to $1 million mortgage. But if you bought a house after December 15 of 2017, it's up to a $750,000 mortgage that you can deduct the interest on. State, local property taxes are capped at $10,000. So I was talking to this lady last night. She said, wow, the CPA capped my taxes last year. Well, it's because her house was worth a lot, and she had a lot of property tax, and they capped that at $10,000. But for an awful lot of people, it's basically going to look like this exemption that they're going to use, $24,800 for a married couple or $12,400 for a single taxpayer. So it's your tax minus that. That's your taxable income. Pretty darn simple. All right, so let's keep going here. So a lot of what we get into is taxes now versus later, a conversation on this, because conventional wisdom was always, well, my taxes now are higher, but when I retire, my taxes are going to be lower, right? So marginal rates now versus in retirement. Well, conventional wisdom probably kind of obsolete right now, because we're at about a 30-year historical low tax bracket. So when I came out of college 30 some years ago, I think I came out of college, my first job was about, I think I was making $21,000, which at that time was pretty tall cotton, right? I was doing pretty well. My tax bracket was higher than it is today. So that just gives you an idea. And you look at our federal deficit right now, we have, a huge deficit. The government spends over $5 trillion a year. Got a $24 trillion deficit, $100 trillion in unfunded obligations, Social Security, Medicare, and Medicaid. And our tax revenue is about $3.5 trillion. So when you look at the big picture today, you think, well, conventional wisdom, I don't know if in retirement, my taxes might go up. So, and the other thing that we look at, like mortgage interest. So I'm looking at my taxes now. My mortgage interest, that decreases obviously as you pay your mortgage off. Child deductions, almost gone now, right? I've got 3 kids and my last one's a senior in college, and those are almost all gone now. It was really nice when I had all those. Tax-free versus tax deferral. You know, that's when you get into Roth, you know, municipal bonds, those types of things, and we can help people navigate, you know, when does it make sense to shift money maybe into some of those types of things. And then long-term capital gains. So long-term capital gains, what a lot of people don't understand right now is a single taxpayer up to $39,000 and a joint taxpayer up to $78,000. Capital gains tax is 0. There is none. From 39 up to $434,000 for a single taxpayer, and from 78,000 up to 488,000 for a joint taxpayer, 15%. So capital gains, very, very low. I'm going to talk about that in a minute too, about investments inside or outside an IRA and what you have to be careful of there. So tax planning with the retirement accounts. You all have a TSP plan, I believe, which falls into this category over here, which is very similar to a 401k or a 403b or a 457 plan. A lot of those plans, they go in, they're tax deductible going in, oftentimes get a match. Traditional IRA, same thing, tax deductible going in, limited on income, and very limited on what you can put in. Roth IRA, you can contribute to. There's also income limitations on that one, but it's after-tax contributions going in. And non-qualified investment accounts are also after-tax going in. So these two are going in after-tax. These two are pre-tax. We call those qualified accounts. Non-qualified are going in after-tax. But we've been taught to deduct, now, put as much as we can in those traditional plans where we can deduct money today. But again, if you think about it, we're deducting at a 30-year historical low tax bracket to maybe pay a higher tax later. That might not make the most sense. And let me show you an example here. I just typed it on a Word document so you can see it. So the rule of 72, you may have heard that before. The rule of 72 says if I take 72 divided by my interest rate, it tells me how long it takes my money to double. So if I got a 7% interest, 72 divided by 7, basically 10 years for my money to double. Okay? So if I use a $10,000 investment that I can deduct, so I got the whole 10,000 working for me, I don't have to pay taxes. I'm going to IRA or my TSP or 401k, put it in there, I get a 7% growth rate. In 10 years, my money doubles to $20,000. Now, let's just say I'm in a 25% tax bracket, so I have to, eventually I've got to deduct those taxes out of that $20,000. That leaves me with $15,000, right? Well, what if I went into something that a non-qualified account or a Roth, and I put 75, you can't put in that much, but just as for an example, I put in money after tax. So I got to pay $2,500, my 25% taxes first. I get that money, I pay tax, and then I put it into an investment, growing at 7%. In 10 years, it doubles to $15,000. I'm left with the same amount of money. I'll tell you what, I've showed people that time and time again, and they're like, wait, what? Wait a minute. You're left with the same amount of money. So if I am in the same tax bracket or in perhaps an increasing higher tax bracket, it certainly might make sense to put some money in after-tax accounts and not those tax-deductible accounts. Okay, moving right along. Here we go. And let me make that screen bigger for you here. Wish I could get some feedback. There is a chat box, by the way. On the right-hand side, we'll take questions at the end. There's a chat box on the right, and you can type in questions there. I've got Kiana that's going to help me with that, but I can try to answer those as we go. But All right, so those are our retirement accounts. Oh, another example. Oh, one thing I wanted to mention, and this is as good a time as any. You got to be careful about accounts like an IRA, and I mentioned in the previous couple of slides, stocks inside an IRA. Nothing wrong with that. However, we receive a step up in basis on things like real estate and stocks. So if I put stocks in an IRA and they appreciate substantially, everything coming out is going to be taxable. A lot of people roll money over from a TSP or a 401k, they put it in stocks, so stocks are appreciating. Well, when they come out, it's all taxable. If I hold that outside an account and I sell that stock that's appreciated, I have a capital gains tax, which is historically always lower. We just talked about those at 15% for most people, are lower than our ordinary income tax. So be careful there about your stocks. We had a client that was Thomas Edison's great grandson. He had original shares in GE stock, original shares. It was worth about $14 million. So his cost basis was virtually nothing. But he's got 14 million, so he'd have capital gains on that. So he'd have to pay capital gains on that, but not ordinary income, which would be a lot lower, right? Well, if he had that inside an IRA, 100% taxable coming out. So if all that stock was in an IRA, everything would be taxed at his ordinary income instead of at a capital gains tax. In his situation, it'd be the highest amount. Capital gains would be 20%, but that's a whole lot higher, better than his probably close to 40 or 45% in ordinary income tax that he'd have to pay. That's a several $1 million mistake there, the way he, he actually had it outside the IRA, which is smart. But if he had it inside the IRA, that would have been a several $1 million mistake right there. So taxes with investments. This is so you'll 1099 dividends, interest earned. What many folks don't realize is you'll get things. Sometimes you'll get a tax bill in the mail on your mutual funds when your fund may have gone down. And why is that? I got a $20,000 mutual fund. It's worth $19,000, and I still got to pay tax on that, capital gains and dividends. It's because they're selling stocks and bonds inside that mutual fund account. They still have to report that. So even if your account went down, many times you're getting a dividend or capital gains statement that you have to pay taxes on. Rental properties. So rental properties, again, the nice thing about rental properties is that we have a step up in basis for those when we die. So if I have a rental property and I'm depreciating that rental property to offset some of that rental income, that decreases my cost basis. So I have a rental property for $300,000 and I depreciate that thing, I can depreciate all the way down to zero. So my cost basis would be zero. So if I sold the property while I live, I got full capital gains on all $300,000. If I just wanted to pass that to my heirs and I died, my heirs would pick up that property and their cost basis would be $300,000. It steps up. It's a step up in basis. So they sold that property, there would be no property or no capital gains costs at all. Another strategy I'll show you in a minute that you can also do with rental properties. Long-term capital gains, I think we've pretty much covered that. Again, historically always been lower than our ordinary income taxes. For a lot of people, that capital gains is zero. For most people, it would be 15%. But boy, it doesn't go, again, for a joint taxpayer, it doesn't go to 20% until you exceed $488,000 in income. So long-term capital gains is very favorable. Ordinary interest and dividends, kind of covered that. And then alternative minimum tax, that's just a kind of a cruel little tax they throw in there. If you make too much money or you have too many exemptions, like even when I do my TurboTax, and I showed you how easy the taxes were to do, I do my TurboTax, at the end it says, okay, we're going to calculate your alternative minimum tax as well. It doesn't affect a lot of people, because but if you have too many exemptions or too much income, some of those exemptions could be, or those they could be wiped out when they do that alternative minimum tax. So got to be careful there about that alternative minimum tax. Okay, so tax planning for estates. We'll switch gears a little bit. Revocable trust versus irrevocable trust. A revocable trust means that I put money into a trust if I'm the grantor, and I can change it. I can take it back. I can do whatever I want with that. I still own it. So I probably won't have any tax benefits with a revocable trust. An irrevocable trust is something that I put in and I can't take it back. It's irrevocable. I can't change it. It's basically I gift it into a trust. That generally would have some tax benefits associated with it. We won't get into too much of that right now, but irrevocable versus revocable. And if it's irrevocable, I might have some tax benefits there. Revocable, I would not. Wills, common misconception, a will does nothing at all for tax planning purposes. But in my opinion, everybody needs a will, because there's 3 parts to a will. It's the last will and testament, what happens to my stuff. And maybe more importantly is a durable power of attorney. I name somebody to help me if something happens, if I'm incapacitated, I need somebody to help me make decisions. And then medical directives, that's a big one. What do I do if, do I want to be kept alive by a ventilator or whatever, and this comes into play. I'll tell you what, I had a sister, 57 years old, had a stroke in 2017 and didn't have any of this stuff done. And at one point she was on a ventilator, and unfortunately she passed in 2018 because of complications from it. But there were times when we were just looking at each other as siblings, like, I don't know what she would have wanted done. I don't know. What do we do? It was very, very difficult. So highly recommend you get that wills done, at least to have your medical directives there and a power of attorney. And then what happens to your stuff. But again, there are really no tax benefits at all. Estate inheritance, estate death taxes. So this used to be a big deal when I got into the financial services industry 31 years ago. We all have an unlimited marital deduction. So if a couple's married, doesn't matter if you're Bill Gates, you can pass everything to your spouse, and there are no estate taxes. Where they come into play is at the second death. So Bill Gates example, for example, when he passes away, if he passed first, he could pass all his, I don't know what he's worth now, 100 billion, I don't know what it is, but he could pass all that to his wife, no estate taxes. But then when she dies, there'll be estate taxes due. So 31 years ago, it was we could pass $1.2 million between 2 spouses, and it was $600,000 per person. But if I use my unlimited marital deduction and passed all $1.2 million to my wife, I blew that first $600,000 exemption. So when she passed, she could pass the 600, but 600,000 would be taxable. At that time, it was $192,800 in taxes. So just by not setting it up properly, I blew that first exemption. Well, the reason this isn't such a big deal anymore is because that number was indexed and it changed. And I've been in those 31 years in the financial services industry. I think in that time frame, the number of tax changes we've had, about 31. Just about every year they change something. Well, this estate tax one's a big one. Changes all the time. So now, instead of 600,000 or 1.2, we can all pass $11.58 million estate tax free. So for the vast majority of us, it's a moot point. If you're lucky enough and you're more than that, you can join with your spouse, and you can give away over $23 million now by setting up the right type of documents to our heirs. But that's due to sunset in 2025. That is due to sunset and come back to $5.4 million. Still, for the vast majority of Americans, that won't affect us. But will it be $5.4 million? If you want something entertaining or maybe that will kind of make you depressed, Google U.S. debt clock. US debt, D-E-B-T, debt clock. You pull that up and you'll see numbers churning like a slot machine. And they talk, and I just did it a few days ago. That's why those numbers were fresh in my mind, is our revenue versus our deficit versus our spending, and it's scary. Well, if you look at that and you think, well, where are they going to get money? They've got to get money somewhere. And now this new stimulus package, right? $2 trillion, and there's supposed to be a couple more packages coming out. It could be $6 trillion or even more before it's all said and done. Who's going to pay for that? Where's that money going to come from? Well, so they look at this estate tax thing all the time and say, kind of a cruel tax in one way. You know, my blood, sweat, and tears. I had a client had a cleaning business worth $140 million, but that guy, blood, sweat, and tears, built that thing, took a lot of risk, and built it to an empire of $140 million. Well, when he dies, yeah, he can pass away past 23 million, but the 120 million is taxable at about 40%. He'll have about $50 million in estate taxes that he will owe. So in one sense, it's kind of a cruel tax, but the government looks at that and says, boy, that's a lot of revenue. We can get some from large estates. So 2025 is due to sunset to 5.4 million, but would it go even lower than that? Wasn't long ago at all. It was about 3.5 million. I think Obama administration, it was 3 million to 3.5 million. So will it drop to that? And then it catches a lot more people, because if you have some rental properties, you have your pension, you have your house, and then what a lot of people don't realize is you have a life insurance policy. That's all included in your estate, and that could be estate taxable. So for right now, we're okay, but that's always changing, so you never know there. Rental properties, again, we talked about the step up in basis if we have those when we pass away. All right, so most common tax mistakes, and how we doing on time? Oh, we're great. Shoot, we're only got a few more slides left here. It's just about noon. Most common tax mistakes are not reporting all of our income. So if you have little side businesses, for example, or you had a business where you get a 1099 once in a while. You know, at one point I had a business in financial services, and I did business with lots of different companies. I had 8 or 9 1099s. And once in a while, those companies would not send them out. And I get something from the government saying, hey, you didn't report something here. So you got to be careful. A misplaced W-2, you know. I'm doing my TurboTax, and I'm just about finished. I'm like, wait a minute, wait. I know my wife did something, you know. So there might have been a 1099 or W-2 that we misplaced. So you got to be careful about reporting all income, obviously. Too aggressive with deductions. This often happens with healthcare expenses, you know. So you can deduct, so of course there's a minimum you have to hit with healthcare expenses, but if a doctor prescribes an over-the-counter medication, people think they can deduct that. They can't. An office in your home, you certainly can, but you know, you need to use that as an office. People are sometimes pretty liberal about deducting things in their home, and they got to be very careful. So just a common mistake is being a little bit too aggressive. Not filing a timely return. As you all know, this year we got extended to July 15 was the last I heard. I don't know if I got extended again or not, but July 15. Normally, everybody's kind of etched in your brain, it's April 15 is that date. But it's, you know, there's expensive fines if you don't file that return and you owe money. Even if you file an extension, you still got to pay your tax due. If you don't pay your tax due, you're going to get penalized on that. And those penalties can be hefty. And interest rate, and they charge interest on there, which isn't cheap either. Not tracking basis on investment accounts. Boy, I wonder how many people make this mistake, because again, I do my TurboTax. And when my kids were in school, especially, we sold a fund, right? Cashed in a fund to pay their tuition. When I put that down there that I cashed in that fund, again, slot machine, there goes my tax bill going up. But then I look further, I'd have to find it maybe on a different form, what my basis was. I plug that back in, boom, slot machine going back down. Relief. But I thought to myself, boy, how many people, if the basis isn't on that form, which sometimes it isn't on your tax form, you might have to look that up. you know, it increases your tax, and you got to make sure you're reporting that basis, because you only need to pay tax on that gain. And then claiming all your dependents. Again, you know, I'm losing all mine, unfortunately, but it was nice when I had those dependents as my kids. My youngest one is a senior in college, and I get to claim him for one more year, and then that's it. But just making sure you claim all your dependents that you can as well. All right, filing status. So these are the common, most people I think understand these: single, married filing joint, married filing separate, head of household, qualifying widower. Just a note there to be careful on the head of household. This is not for, you know, people think, well, I'm the head of a household, you know, but it's not for married, it's for single or unmarried, who are the primary income earner and paying more than half of an expenses for a child. So it's not like, oh, I'm head of the household and, you know, my wife and kids and, you know, my wife is a stay-at-home mom or whatever. No, it's a single taxpayer, and you have, again, you're paying more than half the expenses for a dependent child. So just careful on that one. Qualifying widower, talked to a lady last week who is a widower, and she can actually file a joint return for 2 years, and she had a dependent child. File a joint return, so she got a much larger exemption, or exemption of 24,800 versus 12,400. So a nice little benefit there that a qualifying widower can file as a joint return for 2 years after the death of her spouse. Marital status determined on the last day of the year. So if you're married on December 31, you can file a joint return that year. So for most people, that's a benefit. So it doesn't matter what day of the year you're married, you can file a joint return that year. Married filing separate: if one spouse itemizes, then the other must also itemize. Rarely see this, rarely. Married filing separately, but again, if one spouse uses the exemption, you have to both use that, or if one itemizes, you both itemize. But again, rarely see married filing separately. It's always married filing jointly. All right, so the last slide I want to talk about is the charitable remainder trust. And we threw this in here because this is a brilliant planning tool, often talked about. Again, 31 years in the financial services industry, and this thing is talked about over and over and over because it's a brilliant planning tool. But when it comes right down to it, people don't do it. However, once I started volunteering at the foundation, I see them doing it. I think they average 2 a week that they do in charitable trusts. And it's just a brilliant planning technique, and we wanted to throw that in there. It's not for everybody, but a lot of what we do is tax planning and try to save people taxes. One of those things is, you know, I got an IRA, it's all going to be taxable. I got required minimum distributions, which was 70.5, and the new law changed that to 72 now. But at age 72, I have to take out these required minimum distributions, and I got to pay tax on that money. Well, a lot of people have an IRA, they think, well, I'm just going to leave it for my kids. Well, that's all taxable, and if you die, it's going to be taxable to your kids. So a lot of what we're doing is we're saying, well, what about a Roth? A Roth is not taxable to you or your kids, and there's no distributions you have to take out and pay the government. But when you convert it to a Roth, you have to pay taxes. So one way to offset those taxes is to make a contribution to a charitable remainder trust, because you get a big tax deduction that could possibly offset those taxes that you have to pay to convert your IRA to a Roth IRA. So again, just throwing this out there as an example. And you can go, if you can Google charitable, CRUT, charitable remainder unit trust, CRUT calculator. I just did it this morning. I Googled CRUT calculator. I pulled up, I think, the American Red Cross, and I looked and I put in the numbers. If I had $200,000 donation by a 60-year-old, you'd receive a $76,000 deduction. So like this picture shows you, the donor repositions an asset into a charitable trust. You would receive income for life. It has to be a minimum of 5%. You can receive between 5 and 10%, but a minimum of 5% up to 10% income for the rest of your life. And I believe it's 10% of that original asset. I should have checked that before we did this, but I think it's 10% of the original asset has to pass to the charity. But you'll receive income for life and you receive a huge tax deduction today. So for a 60-year-old putting in $200,000 is a $76,000 deduction. For 65-year-olds, it's a $90,000 deduction. What can I do with that deduction? Well, lots of things. So we help people, you know, again, offset converting a IRA to Roth, offset other taxes that you might be paying from rental properties or dividends and interest and capital gains. So we're offsetting taxes. It's just a remarkable tool to use to offset taxes, and it's a great thing to do for charities, and it can provide income for life. So it's a fantastic tool, not for everybody, but really great tool, and the foundation does more than any I've ever seen in my lifetime. All right, questions and answers. So we're pretty much done with the presentation. Just one last comment on the taxes. Obviously, it's never the one size fits all. A lot of you are comfortable with the CPA, and if you have rental properties, especially, or you have a lot of investments, certainly you might need a CPA. When I had a business, yes, I used a CPA at times. Again, I eventually gravitated, since I'm so close to this, I eventually gravitated to doing that myself as well. But it is to say that a lot of you could be doing it yourself or using something like TurboTax. It's pretty darn simple. But so, and I'm here to help you. So when you do this evaluation form, first of all, we'd love your feedback on what you thought of this presentation and any other presentations you'd like us to do. I think there's a few examples in there that you can check off that we'll be happy to come back and do other presentations for you. If you need help, if you want help with a one-on-one consultation, again, we do that through the foundation. There's no cost for that. As I said, I was helping a lady last night. She called me. I said, you can call me anytime. I talked to her during the day, and she called me like almost 9 o'clock at night. And I said, well, I kind of meant you can call me anytime, but you know. But anyway, I was happy to help her, and I walked her through TurboTax. First time she's ever used it. I think she's around 65 years old. First time she's ever even attempted tax on her own. She was like, oh my gosh, I am never paying the CPA again. She was so thrilled. It was so simple. But anyway, happy to help you do that. Happy to help you anything that you want to talk about in a one-on-one consultation. They have some great folks at the foundation that can help you. All right. So with that, if you want to, if you have questions in the chat box over there, you can do that. Or you can also mark it down there, your evaluation form, we can get back to you there. So I did have one question. If you own a nonprofit organization and accrue some out-of-pocket expenses, is that tax deductible? Sure, they would be tax deductible. You bet. Yeah, you can deduct any expenses that you have. Those would be tax deductible. Any other questions? I'm not seeing much in the chat box, and it is 12:10. So finish a little bit earlier than normal. Okay, I guess we have no more questions. So, man, I so prefer doing these live. It's so much fun to, throw out questions to the group and get the feedback and use a whiteboard and show a couple of examples. And but that's the world we're living in right now, and we'll get better about, using whiteboards on our go-to meetings and things like that. But I hope you got something out of this, and I appreciate your time today. Again, please feel free to reach out to the foundation. With your evaluation form, you can check off a box there if you'd like to speak with someone, if you have something that pertains to you individually. Happy to answer those questions. Sit down with you virtually and go over anything that you'd like to for your personal situation. So thanks so much for tuning in. And again, you have a copy of the handouts, but anything else you need, just go ahead and get a hold of us through the foundation and the evaluation form. Thanks so much.